Good morning, dear students. Good morning, Geet. Good morning, Megha. Very good morning, everyone.
Good morning, sir.
Morning, sir. Okay, so we are in the last session of advanced capital budgeting. Okay, uh, we have come quite a way ahead when it comes to this topic of advanced capital budgeting. So what we have done till now, let me just recap within a span of 5 minutes, and then we can take up the further discussion. Okay. So first thing that we did was impact of inflation, and there we have simply stated that the cash flows can be nominal or it can be real. The real cash flows are supposed to be discounted at real rate of return, whereas the nominal cash flows are going to be discounted at nominal rate of return. Okay, so we say 1 plus the real rate multiplied by 1 plus inflation is equal to 1 plus nominal rate. Okay, so that was a broad relation between the cash flows, relation between the rates. So it depends what sort of information is given. We can use the real cash flow, real rate to discount the real cash flows, or nominal rate to discount the nominal cash flows. One important aspect that we discussed over here was the tax saving on depreciation is always going to be the term that we get in real terms, because in fact the real term and nominal cash flow for the tax saving on depreciation is going to remain same, because government doesn't adjust your tax saving according to the inflation. Okay, so post that we have also started with the risk adjustment thing, so wherein we initially encountered the statistical method, and in that statistical method what we have essentially done is calculated the expected value, standard deviation, coefficient of variation, right? So higher the expected value means, of course, the higher NPV we are expecting, then the standard deviation as a measure of risk, and that standard deviation was supposed to be divided by the expected value to arrive at the coefficient of variation, and this coefficient of variation was useful for comparing two or more projects. Okay, then we have the cash flows and the probability. Okay, so cash flows and probability will be given to us, and based on that we can calculate the expected cash flow, and expected cash flow in turn is going to help us to calculate the NPV of the project. Okay, then we did some questions wherein let's say expected cash flow is calculated for each of the years, and standard deviation is calculated of the cash flow for each of the year. So how do we get the NPV of the project, right? So NPV of the project, as we have seen in this particular question, yeah. So variance of the NPV is going to be like variance of cash flow of year 1 upon 1 plus R the whole raised to 2. Variance of cash flow of year 2, that's going to be discounted for 2 years. But then since variance is a squared term, even the denominator needs to be squared, right? So that's how we got the variance of NPV, and based on that we also calculate the standard deviation. Then we also determine the expected NPV, and also identifying what is the best and what's the worst case NPV, and coming out to be realistic estimate. Then the next thing that we did was certainty equivalent, right? In fact, that was a risk adjusted discount rate. First we did. So risk adjusted discount rate is basically adding your risk premium to the risk free rate, right? Adding risk premium to the risk free rate so that you get a higher rate of return, and that higher rate of return was used to discount the risky cash flows. Other way of incorporating risk into our calculation is to calculate certain cash flows and then just take the present value based on certain cash flows. So investment proposal, let's say 45 lakh that we said over here, that was certain, but the future cash flows were subject to risk, and we just identified what's the certainty equivalent. So certainty equivalent was simply what proportion of your certainty equivalent is simply what proportion of your cash flows is certain or is 100% sure. Now, since we're taking only the certain cash flows over here, we are going to discount the cash flows using the risk-free rate. Okay. After that, we understood the next method as the what we say as scenario analysis, sensitivity analysis. So we said that there are multiple inputs that goes into the capital budgeting process, and the final output is the NPV, right? So we wanted to identify which of these inputs are going to be the most sensitive one, right? So when we say most sensitive, a small change in these inputs is going to have a big impact on the NPV. So what we essentially try to do is we try to change the inputs in such a way that we observe some negative impact on the output. I mean, that the NPV should fall, right? So changing the investment, we would like to see what is happening to the NPV, right? Changing the sale price, changing the units, changing the variable cost, all these things were changed. And we identified which of these factors are the most sensitive one. Now, what's the purpose of identifying the most sensitive one? Because we would like to have a greater control over these units, or we would like to have a greater control over the those particular input. Like over here, we had a greater sensitivity attached with the selling price per unit. So we can say the selling price per unit is the most sensitive input and should have been correct contribution, right? And should have been that should be having proper control over the selling price, because if the selling price changes by a small margin, the NPV is going to get impacted in a big way. Okay. Then we did the scenario analysis, wherein we tried to calculate the NPV in different scenarios. It can be like worst case scenario, most likely, or best, or it can be multiple scenarios. And those scenarios were cohesively used in synchronization with all different factors changing. And we would like to have an idea about the range of NPVs which may come across. Okay. So that is what we have done till now, which is the sensitivity and the scenario analysis. Now, let us go for the next method, which is simulation analysis. So it's just a brief simulation analysis that we would like to do. Okay. Because we don't have the process to follow, the entire thing. So what is first simulation analysis? Let's try to look at the steps, right? Okay. Now, and I would definitely like to show you how this simulation is carried out with multiple scenarios. I will use Excel for that model for you, right? So we'll just spare around 15-20 minutes to understand what this simulation is about. Okay. Now, steps involved, just have a look at the steps. Then I'll definitely do it for you in Excel mode so that we're able to understand it in a more better way. So first step is modeling the project. So the model shows the relationship of NPV with the parameters and exogenous variables. Okay, so what do you mean by exogenous variables? It means the input variables that we're talking of, like the sale price, the units, the variable cost, the fixed cost, the number of years, all those aspects. Okay. The parameters are input variables specified by the decision maker and are held constant over all simulation runs, right? So you have the parameters which is going to be constant, like for example, number of years or maybe cost of capital. So certain input which are constant, that's not going to change. And exogenous variables are the input variables which are stochastic in nature. Stochastic means which are likely to change and are outside the control of the decision maker. So for example, if we have multiple factors affecting the NPV of the project, right? So let's say we have sale price per unit, variable cost per unit, fixed cost, tax rate, right? Then cost of capital, years of the project, right? Then initial investment, right? Right. So these are basically units. So out of this, you can say that the cost of control is within my control, right? To some extent, you can say years is something which is fixed. Okay. And for all practical purpose, let's say the tax rate is also fixed. So these are the parameters. So when you say parameters, we say no change. There's no change going to happen in these three parameters. Then when we look at sale price per unit, variable cost per unit, and fixed cost units, investment and units, I can simply call them as, exogenous variable. Now, what do you mean by exogenous variable? What do we call by exogenous variable? What do you mean by exogenous variable? Yeah. When you say exogenous variable, as I said, these are subject to change. Sale price is not in our control because it depends on the demand that we have in the market. Variable cost, same way, we may say that it's subject to some amount of range. Fixed cost also may change, investment may change, units may change. So these are the exogenous variable, right? So are we clear what are exogenous variable and what are parameters? Everyone?
Yes, sir.
Yeah. So in our model, we define those things, parameters and exogenous variable. Then first we specify the parameters and probability distribution of exogenous variable. So you're giving the exact values of parameters like the number of years, the discount rate that is fixed, and you're going to give a range of values of the exogenous variable. So whatever is the exogenous variable, you provide a value. For example, sale price may range from 60 to 100. Then variable cost may range from 20 to 40. So you give a range, you provide a probability distribution for that. Okay. Then select a value at random from the probability distribution of each of the exogenous variables. So these exogenous variables, out of these exogenous variable, each one of them is going to be used to obtain a value, right? So you select a value at random from probability distribution of each of the exogenous variable. Then determine NPV corresponding to the randomly generated value of exogenous variable and pre-specified parameter variables. Okay, so we're going to determine NPV, which is corresponding to the randomly generated value of exogenous variable and pre-specified parameter variables. Right, so we look at what is the NPV value for the fixed parameters and the selected random variables. So we repeat these steps, large number of times to get the large number of simulated NPVs. So you'll have multiple NPVs at multiple levels, and then you plot the probability distribution of NPV and compute a mean and standard deviation return to gauge the project's level of risk. So you'll have multiple values for different distributions, different values, and then you talk of the possible values of the NPVs, right? So over here, let's just try to get this done in the form of an Excel working. Would you like to have a look at it, guys? How this simulation is carried out in real life?
Yes, sir.
Yeah. So I'll just open up an Excel file for you. Okay. So let us define certain parameters. Okay, let us define certain parameters and let's define certain exogenous variable. Let's keep our model very simple. Okay, out of parameters and exogenous variable, which is subject to change, which ones are going to change? Which ones are going to change and which one are the constant values?
Constant value like years, cost.
Okay. So let us keep over here years and the cost of capital. Okay, let's do the parameters variable. Okay. So let's say life of the project is 5 years. Okay. And cost of capital, I'm just keeping it at 10%. So these are not at all going to change. Now, exogenous variable, I'll say selling price per unit. So I'm going to say that selling prices per unit is going to range from, let's say, 70 to 100, because that's not in our control. That's likely to be from in a range of 70 to 100. Then variable cost per unit is likely to be from 30 to 60. Okay. Units that we can sell, that is going to, let's say, range from 10,000 to 12,000. Okay. So we can have the units range. Then value of fixed cost. So fixed cost, we are talking, let's say, we may have like fixed cost of 3 lakh to, or not 3 lakhs, sorry. It may range from 2 lakh to 7 lakh. Okay. So we've got the selling price, variable cost, units, fixed cost available with us, and investment. Investment, we say investment can range from okay, so investment can range from, let's say, one second, guys. Six lakh to 10 lakhs. Okay. Okay. So these are the range of values that we may have. Now let's run the model. So I'll just put up a simple model over here to calculate the cash flows. So based on these exogenous variables, we can definitely have the input, which is going to be randomly coming up in each of these ranges. So I use the Excel function called as rand between. Okay, so randomize between 70 and 100. Next number is random number between 30 and 60. Next number is random number between 10,000 and 12,000. Then we have fixed cost as again random number between 2 lakh and 7 lakh. Investment value, let's say ranging between again 6 lakh and 10 lakh. Okay, so these inputs are subject to constant change. These inputs are subject to constant change. So let us do one thing. Model is to first calculate the cash flow after tax. Now, how do we get the cash flow after tax? Or just, we can say it is cash after tax. Let me just take it as cash flow. The cash flow is simply going to be, can I say, selling price per unit minus variable cost per unit multiplied by units minus fixed cost. That's the cash flow. Then we'll say present value of cash inflows. Right, so present value of cash inflows, I'll use directly the Excel function over here for calculating the PV or the present value. So present value at the rate of 10%, number of years is 5, and we specify that this is the cash flow or the every year cash flow that we have. Okay, so that's going to be the cash flow, present value of cash inflows. Then we say NPV, which will be PV of cash flows, PV of cash inflow minus cost or minus investment. Okay, so we'll simply say that is going to be PV of cash inflow minus the investment value, which is defined over here, right? So we get this model values in this case. Okay.
Okay.
Okay. So now we have the input, we have the model coming in, and this is the present value. This is the NPV. Now, obviously, what I need to do in this model is, just press enter. At every enter, I'm going to get a different NPV value. So let us just note it down for all the possible values of, NPV. So what are the possible values of NPV that we can observe? Let's say I want to see what are the different 100 possible NPVs. So what I can essentially do is, I'll just copy paste it throughout for 100 times, and I will be able to see what is the range of NPV values. So for that, let me just do one thing. Let us just fix certain parameters so that I can, drag it and get the possible values of NPV. Okay. Now, this is simulation number 1. Same way, I'll get 100 such simulations, guys, because it's Excel. For it, it's easy for me to get multiple simulations. So where have we reached? It's 78. Okay, so let's say we are having 100 such simulations. Okay, what I just need to do is I'll just copy paste it here. So let me just see whether everything has been done perfectly. Okay. Okay. So let me just drag it, right, and get the values for 100 different cycles. Okay. Sorry, this is something different coming out to be. Wait, this is not going to work like that.
I think we should also copy input for 100 times. Or
No, it's not. We're going to get all the values as same. So I need to change the input also. One second, I'll just bring it. The input is getting constant, no? So we should keep changing the input also. The input will be also having 100 different values.
Yes, so input cannot be a constant on this other cases.
Yes. Perfect. Okay, so years and cost of capital should remain constant.
That will be constant, right?
And again, this can't be constant. So this is going to be like, even the inputs need to be changed over here. So now if I just take it over here, you can see we have a different set of values based on the second line of input. Okay. Now I'll just copy this also multiple times. Okay. We got the multiple inputs. Now let me just copy the model over here. We have all the NPV values. You can see a range of NP values, some positive, some negative numbers. Now I want to have a generalized view about what's the mean and standard deviation of this. Okay. So again, obviously, since it's not possible on pen paper, we can simply do it as expected NPV. We can simply take average of all of them. This is expected NPV. And the standard deviation, we can say it is STDEV. That's the Excel function for getting the standard deviation. Right. So what we observe is expected NPV is negative with a standard deviation of 7,72,473. So at any point of time, like if you run any number of trials, we are observing that NPV is more likely to be negative. Right, guys? Yeah. So you can see multiple simulations we have done, and the expected value that we are seeing is the NPV is coming out to be negative. Right. So what should we do with this? Should we accept this project or should we not?
Not to accept, sir.
Not to be accepted, because the NPV turns out to be more often negative, and even the average of all the values is coming out to be negative. Okay. Perfect, guys.
Right, sir. At any situation also, this tending to the negative.
Yeah.
So those simulation only useful to check is there any possible way of getting NPV.
I mean, over here there are certain values which we have the positive NPVs, but if you look at an overall scenario, it's in the negative area. So ideally, we should be avoiding this project. Right? Got it, everyone? So just idea was just to tell you how this simulation works. Right? It's not going to be obviously possible to be done in a pen paper mode, right?
Yeah, sir, in real life, are we using this method, sir?
Yes, it's used very heavily, but we have specialized software. This is our very simple model that we have done. We define the parameter, we define the exogenous variable. You can have hundreds of different variables, like sale price, or you may have the market demand, the elasticity of demand, then the labor cost, the government actions, tax rate. So you can have n number of such variables and try to look at what's the possible value of NPV by looking at all the array of exogenous variables. Make sense, everyone?
Yes, sir.
Okay. Now, so if you look at the advantages, we can see it predicts all types of bad market conditions or situations beforehand. Handle problem characterized by numerous exogenous variable, complex interrelationship between the parameters, and also compel the decision makers to explicitly consider interdependencies and also the uncertainties that we have featuring the project. So shortcomings are like difficult to model because it's not possible to have a model, and even if you're creating a model, you will not be sure that the particular model is 100% accurate. Right? So simulation is inherently imprecise. It provides rough approximation of probability distribution of NPV, and hence may be sometimes misleading when a tail of distribution is critical. Right? It provides a rough estimate. It may be possible that it may give you average to be positive, whereas the real situation may not be that. Right? So first up, it's going to be complex, and also decision makers lack understanding of the model may not use it. Someone who's not really good at stats, they may not be able to understand what this simulation is, and they may not like the the process as such. Okay. Now we have the next analysis, which is regarding the decision tree. Okay. So how do we go about doing the decision analysis? Let's just try to understand this with the help of certain decision trees. Okay. Okay. So we are going to do decision tree analysis. Now, every time we make a decision, okay, we are likely to face two or more situations, right? And a holistic view of that possible values of all those outcomes is what we are going to analyze in this decision tree analysis. Okay. So just remember that in decision tree, there are two conventions that we need to follow. Whenever you're supposed to be deciding on something, it's going to be represented by a square, which is also said to be the decision node. Okay, so whenever we have to decide something, we're going to represent by way of a square. And based on that decision, whatever outcome we have, that's going to be represented by circle. That's your outcome node. Okay. Now, decision node, let us say, first we are deciding whether to go for testing a particular medicine or a particular formula, right? So let us just try to look at testing whether a particular formula should be implemented or not. So medicine or vaccine or whatever it is, right? Or maybe a software. So you have two decisions to make, right? The first decision is to perform the test. Second is don't test. The first decision is to perform the test. So when you're going to perform the test, let's say you're going to pay 2.4 lakhs. So once you have said that you're going to perform the test, it's going to be 2.4 lakhs. So if you're going to perform the test, it's going to be 2.4 lakhs, right? You need to spend 2.4 lakhs. Now, of course, if you test, you can face either of the two situations, that the formula is a success or the formula is a failure. Okay, so let's say I'm having equal chance, wherein I say the probability of success and failure is equal, which means we're talking of probability of success and failure being 50%. So 50% chance that the formula will succeed, 50% chance that the formula will not succeed. Okay. Now, 50% chance that the formula will succeed, we can say that there are two possible outcomes. If it is successful, then I may decide at node C and D. So if the formula is successful, right? If the formula is successful, then we may invest 20 lakhs or don't invest, right? So it's simple, right? If you invest 20 lakhs, you're going to get some benefit. If you don't invest, you're not going to get anything. Now that is in your hands. So I'm not assigning a probability for that. Same way at node D.
Sir, is that B or C, sir? A is there in the first node.
Oh, sorry, I haven't named this. This is B. Okay, so node D, the how? Sorry, yes. Yeah. So when the project is a failure, we can say you can further invest, let's say 12 lakh, or you don't invest. Okay. Now, if you're going to invest 20 lakhs, Okay. If you're going to invest 20 lakhs, you're going to get cash flow of, let's say, 4 lakh per annum till perpetuity. Right? And if you are obviously not going to invest, there's going to be no cash. Right? Then in the second node, if it's a failure, then you're going to have a cash flow of 1 lakh per annum till perpetuity. And if you're not going to invest, then the cash flow is zero, obviously. Right? Now we have to look at what is going to be the NPV of this project. Right? We're going to talk about NPV of the project. So let us first talk of the decision we are going to take. Where should I first take the decision? Remember, node A, C, and D are the nodes at which we are going to take a decision. Node sorry?
Node C, from C, D, and B and A. We have to
first we have to decide what is going to happen in node C and node D. Okay, so we'll say at node C, we are going to decide whether we will invest or not. At node C, what is the first choice that I have?
invest and don't invest.
First choice is invest. How much are we going to invest? 20 lakhs?
20 lakhs.
Right? And get perpetual cash flow. Right? Get a perpetual cash flow of
4 lakhs per year.
4 lakhs per annum.
Per annum.
So what is the present value of cash inflows?
What is the cost of capital, sir, in this case?
Present value of cash inflows, cost of, let's say, 10%. Can I say it will be 4 lakh divided by 10%, which is 40 lakhs?
40 lakhs. Yes, sir.
Less,
20 lakhs it will come, sir.
less investment.
Less after investment.
Investment of 20 lakhs, right? So benefit that we get, or NPV that we have over here, is 20 lakhs, right? Now, of course, the second choice,
0.
choice number 2, invest nothing. Invest nothing. So we can say net benefit that we have is 0. So out of these two choices at node C, what would you choose?
I will choose one, sir. Choice 1.
Should I go for investing or should I go for leaving the investment?
Investor, we have the positive NPV. Choice 1.
Decision will be invest 20 lakhs as it results in positive NPV. Right? Then decision at node D. At node D, what's the decision going to be? First choice is to invest 12 lakh and get 1 lakh till perpetuity. Invest 12 lakh and get perpetual, get 1 lakh till perpetuity. So if you have this situation, what is the present value of cash inflows? This is going to be 1 lakh divided by 10%, which is
10 lakhs
10 lakh less investment.
minus 2 lakhs negative NPV.
Yeah, so you're investing 12 lakhs. So it means you're having a 2 lakh
Deficit of
negative NPV, right? So you're having a 2 lakh negative NPV. So now if it's a 2 lakh negative NPV, and the second choice that we observe, what's the second choice? Second choice NPV is 0. So out of these two, what is going to be your decision?
Will not invest, sir, since
Do
it's
not
negative NPV. And don't invest.
Don't invest, right? So what we find is that at node C, we are having a NPV of 20 lakhs. At node D, we are having an NPV of 0. Right? Because we decided either of these two. So over here it is 20 lakh and over here, of course, it is 0. So if we test, what's the expected NPV that we can get? So if we perform the test, because 50% chance that 20 lakh is the NPV that you will get, 50% chance that you will get a 0 NPV. So what is the expected NPV if test is performed?
10 lakhs.
So expected NPV if test is performed. Then I say it's 20 lakh into 0.5 plus 0 into 0.5, which is 10 lakh. Right?
Yes.
Right. So what is the NPV of testing? Of course, it will be 10 lakh minus initially I need to pay how much for performing the test? 2.4 lakhs. Right. So if I'm spending 2.4 lakh for testing, I'm likely to get an NPV of 10 lakh. So this is obviously going to be 7.6 lakhs.
7.6 lakhs.
What is the NPV of not testing? NPV of not testing. Can I say 0? And so this is at node A. What are we going to decide? Invest or do not invest?
Invest, sir.
Invest. Right? Because you have a choice between whether to earn 0 or whether to earn 7.6 lakh. Of course, I will say I would like to earn 7.6 lakh, and therefore we should be going for taking an investment. Are we good, everyone?
Yes, sir. But the decision tree, we can do normal calculation of NPV, sir, as a historical way, how we do. But decision tree.
What you are going to get the NPV, that depends on your choice.
Okay.
Right. So if you choose this, what's the NPV possible? If you choose this, what's the NPV possible? Right. And then you say that this choice is having a chance of 50%. This choice is having a chance of 50%. So you take the expected value. And then you say whether I should test or not. So you're like backtracking and doing the calculations.
Okay. Which means when we have the more probability and chance, in this case, the decision tree will be useful, sir.
Yes.
Right?
Yeah. In all future contingencies, this is used.
Okay.
In fact, it's more often used when you are looking for oil drilling activities. I hope you are aware of oil exploration that takes place in deep sea areas.
Yes, sir. ONGC.
ONGC or any companies that you for that case. So they have always a choice whether to perform digging in that particular area or not to perform digging. Okay, once you perform digging, there are two chances. You will get oil, you will not get oil. Okay, what if I get oil? What will be the present value that I will get? Achha, what if I don't get oil? I again have a chance to whether to further dig or not to dig. And if you dig further, there are two possible chances again. You will get oil, you will not get oil. Right? So this is what a decision tree will typically look like when you look at it from a practical viewpoint. Make sense, everyone?
Yeah. Yes, sir.
Yeah. Okay. So that's the decision tree analysis that we had. Now, the next aspect that we are going to look at which is regarding the replacement decisions, whether a machine should be replaced, whether equipment should be replaced or not, right? And the other thing that we're going to look at is when we should be replacing it. Okay. So let's look at, possibly we have a question based on that. One second. Yeah, so we'll do this replacement decision based on this question number 11, guys. Okay. Deciding whether to replace a particular equipment or computer or any asset today, or likely to we are going to defer it. Okay. So let us say, let's look at this question and understand the entire concept of replacement decision. Replacement decisions. Okay, look at this question 11. A company named Robbie's Cube decided to replace the existing computer system of their organization. Original cost of the old system was 25,000, which was installed 5 years ago. Right? Current market value of old system is 5,000. Depreciation of old system was charged with a life of 10 years. So estimated life was 10 years, and based on 10 years, the depreciation was charged. So for how many years has the machine been depreciated now?
10 years.
No, 5 years only. Because it's installed 5 years, right?
Remaining 5 years we will depreciate.
Yeah. There are still remaining 5 years. Depreciation of new system will be charged with life over 5 years. So I have a choice over here, whether to continue with the old system or to go with the new system. Okay. Now, present cost of new system is going to be 50,000. Estimated salvage value of the new system is 1,000. Estimated cost savings with new system is going to be 5,000 per year. And increase in sales with new system is assumed to be 10% per year. So sales is going to increase by 10%, right? Incremental sales is what you're going to get from this new system. Company follows, based on the original total sales of 1 lakh. Company follows straight line method of depreciation. Cost of capital of the company is 10%, whereas the tax rate is 30%. Okay. So we have to decide whether the replacement should be done or not. Okay. To decide whether replacement should be done of the old equipment with a new one or not. Okay. So first thing that we do is, when you're replacing your old system with a new, of course, you should be getting some sort of incremental cash flow, right? Otherwise, why are you going to discount it anyways? Correct, guys?
Yes, sir.
So we can say incremental cash flows per annum we need to get. Now, how do we get the incremental cash flow per annum? Incremental cash inflows per annum from the new system. So what's going to be the incremental cash inflows per annum from the new system? Incremental cash inflows. How do we get that? It's simple. First, we need to look at what is the incremental sales. So we need to look at what is the incremental sales, right? On the incremental sales, we will add the incremental savings that we have. Right? We may get something as extra sales, something, some expenses may be saved. And of course, we will need to subtract any incremental expenses. Okay, so incremental sales plus the incremental savings less the incremental expenses. And also, we need to check for plus or minus possible tax impact of additional or reduced depreciation. It's quite likely that most often cases that your depreciation is going to increase, but it's also possible that your depreciation may reduce. So if there is an increase in depreciation, if there's going to be an increase in depreciation, of course, you will be saving tax on it. If there is a reduction in the depreciation, then you're going to pay tax on it. So therefore, I've not written tax saving. I'm just saying that it's a tax impact. Okay. Now, when it comes to this particular question, let me just place it over there. A company named Rubik's Cube, we are going to replace our existing computer system with a new system. So let's first talk of what is the incremental cash flow that we have. Initially, we're going to say what's the incremental sales. What's the incremental sales that we have, guys, here?
1 lakh, sir.
Incremental sales is 1 lakh. Okay. Are we going to save anything in expenses or any additional income that we have? Yeah.
Yes, sir. Yes, sir. 10,000, 10%.
Increase in sales is done based on increase in sales with the new system is assumed to be 10% per annum based on. This is by the way 10 lakh.
So is that a typo?
It's not 10 lakhs, sir. It's a 1 lakh only. It's so 50 only is there after 1.
No, it's 10 lakh. There's a typing error here. I'm talking of.
Oh, okay.
Oh, sorry. Typing error. It's 1 lakh. Not okay.
Yeah.
Well, we'll keep
only
it.
comma is incorrectly placed.
So incremental sales will be 1 lakh into 10%, right? So we have an incremental sales
10,000.
And are we saving anything? Yes. Estimated cost saving will be 5,000 per year, right?
Yes, sir.
We have incremental savings as 5,000. Any increase in expenditure happening?
No, sir.
No.
Nothing is nothing is
So,
based on the question.
Can I say that's the cash flow before depreciation?
Yes, sir.
Before
but
the
there is a tax is given, sir. We need to reduce the tax rate.
Yeah. This is cash flow before. This is basically your profit. I mean, before tax item. So we have this as 15,000. Now on that, of course, we are going to make it after tax. After tax cash flow without depreciation impact. It's going to be at what, 70%?
Yeah. 10,500. It's coming.
10,500. And then I need to have the tax saving on it, right? Correct?
Yes, sir.
So let's work out the tax saving on depreciation now. So we add additional, tax saving due to incremental depre. Tax savings due to incremental depreciation. Okay. Now, what is the old system depreciation per annum?
25,000 divided by 10 years. It will come 2,500, sir.
2,500. Okay. What is a new system depreciation?
Yeah, please show the question, sir.
Yeah. New system depreciation per annum. How much is it going to be?
What is the cost of system?
Cost of system is 50,000.
50,000. There is a
And
salvage
salvage
value.
1,000.
Salvage value is 1,000 minus 1,000
Yeah.
divided by 5 years remaining. It's 9,800, sir, per annum.
9,800. Perfect.
9,800.
That's 9,800. So what is the incremental depre that we have?
The old system depreciation is 2,000 minus 2,500. 7,300, sir.
7,300 is the incremental depre. Now, of course,
Yes,
on
sir.
we have the tax saving.
Yes, sir. In the 0.30%.
Tax saving
2,190.
on incremental depre. Tax savings on incremental depre is
2,190
7,300
into 30%.
into 30%, which is
2,190.
2,190. So what is the net incremental cash flow if the machine is replaced? Net incremental cash flow per annum is going to be over here 10,500
12,690 total.
plus 2,190.
12,690.
12,690. Right? So 12,690, that's the net incremental cash flow per annum. Right? Now, we can definitely go for calculating the NPV of the replacement. Right?
No, we have to identify the cash outflow, sir.
So cash outflow, what is going to be the cash outflow? So I need to look at the cash outflow. So how do we go about looking at the cash outflow here? So I need to calculate the cash outflow thing, right?
Yes, sir.
Right. Okay. So like every year, 12,690 is already counted for, and then we'll have the salvage value only the fifth year. And we need to get the what is the cash outflow today. Right. So we have calculation of cash outflows towards acquiring new system. What will be the cash outflow when we are acquiring the new system? First up, what is the cost of new system?
It's 50,000.
It's 50,000. Okay. Less sale of old system. At what price are we selling the old system?
I think it's 5,000 rupees.
Right. But remember, the old system was not fully depreciated till date.
Yes, the remaining 5 years are there.
Yeah. So what is the WDV of old system.
It's 25,000 minus 12,500.
WDV of old system. It's going to be 25,000 purchase value.
Yes, sir.
2,500 into 5.
12,500.
Yeah. So we have 12,500 as the WDV of the old system. Right. At what price are we selling it? 5,000, right?
5,000. Yes, sir.
Are we having a loss? Yes.
Yes.
So loss on sale is 7,500.
500.
So what will be the tax savings on this?
30%.
So 7,500 into 30% will be saving tax, which is 2250. Right. So we'll reduce from our cost, which is tax savings of 2250. Subtract this. And what's the net cash flow? 50,000 minus 5,000 minus 2250.
It's 42,750.
42,750. Okay, net cash flow is 42,750. Now we have the net cash flow 42,750 and we have all the numbers. Now we can definitely calculate the NPV. Right, guys?
What is the cost of capital, sir?
1 second. Okay, cost of capital is 10%. So we'll talk of calculation of NPV. Calculation of NPV. We talk of year, cash flows, PV factor, and then we take the PV. So in year 0, you have 42,750 payable. Okay. Year 1 to 5, we have net cash flow as 12,690. And then in year 5, you have a cash flow of 10,000. So take the PV factor at 10% and provide me the NPV, guys.
Sorry, NPV is 5,976.
Positive?
Positive, sir.
So positive 5,976. 76, the positive. So should the machine be replaced with a new one?
Yes, sir, definitely.
Yes, the machine should be replaced. True. So it's a normal capital budgeting question. You just need to be vigilant enough to, take a particular cash flow at a particular point of time.
Here, the tax saving is critical calculation, the incremental.
Yes. Correct. Okay. That's the calculation of NPV. Okay, when it comes to replacements, we have a different type of question also, different type of scenario coming up. It's like whether to replace now or whether should we defer it, right? So for that, let's have a look at this question number 12. Okay. X Limited is a taxi operator. Each taxi is costing the company 4 lakh. And it has a useful life of 3 years. The taxi's operating cost for 3 years and salvage value at the end of the year is as follows. So like in year 1, if you operate the taxi, you are going to pay 1,80,000. In year 2, if you're going to operate the taxi, you're going to pay 2,10,000. In year 3, if you're operating the taxi, you're going to pay 2,38,000. Resale value is 2,80,000. Year 2, it is 2,30,000, and year 3, it is 1,68,000. You're required to determine the optimal replacement period of taxi if the cost of capital of X Limited is 10%. Okay. So now we have to decide whether I should replace the taxi every year. Right? Like, for example, you take a taxi, use it for a year, and then sell it off in the first year. Or the second choice is take a taxi, use it for 2 years, and then sell it after 2 years, and again take another taxi. So it's like when you are going to replace the taxi. Is it going to be like after every year, or is it going to be like after every 2 years, or is it going to be like after every 3 years? Right? So every 2 year, 3 year, 1 year, that is what we have to decide. Now, what is the process that we generally do? Let's first calculate NPV if you replace the taxi in 1 year. Then we'll also calculate the NPV if we replace the taxi in 2 years. Then we also calculate NPV if we replace the taxi in 3 years. Okay, so let's first talk of NPV if taxi is kept for 1 year. Right? Okay, so if the taxi is kept for 1 year, what all cash flows are we going to have? So like year, particulars, cash flows, the PV factor, and then the PV. In year 0, you purchase the taxi, which is cost of taxi. Cash flows are negative 4 lakh. Present value factor is 1. So of course, the PV is going to be minus 4 lakh. So year 0, you spend 4 lakh for a taxi. And in year 1, you have the operating cost. Right? So you have the operating cost. How much is the running cost or operating cost of the taxi? That's 1,80,000.
80,000.
1,80,000. The PV factor at 10% for 1 year, it will be 0.909. And when I multiply cash flow with the PV factor, what's the number?
Sir, normally we will round off up to 4 decimals, right? This is a commonly we use it. 0.9091.
9091, yeah. Tell me what's the PV present value of this cash flow?
Cost, it's 1,63,638.
1 lakh?
63,638.
Okay, 638. Then in first year, you'll also have the salvage value, which is 2,80,000 with 0.9091. So 2,80,000 into 0.9091. What's the value, present value?
2,54,548.
2,54,548.
Yes, sir.
Yeah, 2,54,548. That's the present value. Now, of course, this is going to be negative 1. Now, of course, here the NPV is but obviously going to be positive because we have not accounted for the sale value or we have not accounted for the revenue. Right. Anyways, if we just have the cash outflows, net cash outflows, we'll make a choice based on the cash flow, based on the NPV being the lowest negative number. So what's the present value of cash flows over here? Just take a total of all the present values. Total of all the present values, guys.
It's 309090.
Yes, sir, exactly.
9090.
9.
Okay. This is NPV if the taxi is kept for 1 year. Can we also get NPV if taxi is kept for 2 years?
Sorry, NPV is coming in negative.
Yeah, it will be negative. Yeah. So we have year, particulars, cash flows, present value factors, and present value. Okay. So we'll have like 0, 1, 2, and 2. 0 is the cost of the taxi. 1 and 2 is the operating cost. And 2 is the salvage value. So can you just solve it and take a total of it? Yeah. Same way, you can do also NPV if taxi is kept for 3 years. So we have year, particulars, cash flows, present value factor, and present value. So you'll have 0, 1, 2, 3, and then 3. So 0 is the cost. 1, 2, 3, you have the operating cost. And third year, you have the salvage. Here also you can get the NPV. Can you calculate these two NPVs for me, guys?
Yes, sir. We'll work on and provide to you.
Yeah. So calculate the NPV for the 2 years and 3 year timeline.
So, sir, please show me the cost and salvage for third year, sir.
Yeah.
Yes, sir. Ready with the answer, sir.
Yes. Tell me.
For second year, negative NPV 5,47,108.
Okay.
For third year, negative NPV 7,89,794.
7,89,794.
Yes, sir.
Yes. Now. So we have 3 options in front of us. Right. So we've got three options in front of us, which is the replacement tenure, a replacement in year 1, year 2, year 3. NPV is 309090, 547108, 789794. Now tell me, can I compare these three NPVs and take a decision as to when we should replace the taxi?
No, sir, we cannot compare, sir.
Why?
The year is different, sir.
Year, I mean, the tenure for which NPV is calculated is different.
Yes, sir. The tenure for, say, if it is the same, all the cases 3 years, then we can compare.
Correct.
The year is 1 year, 2 year, 3 years. We cannot compare which
Correct.
these things.
We can't calculate it, right? Correct?
Yes, sir. We cannot compare.
So how do we deal with this now? So the only way for that is we calculate annualized NPV. How do we get the annualized NPV? Annualized NPV.
Yeah, equated annual cost.
Yes,
We got to find it.
Annualized NPV or equated annual cost. So we can calculate equated annual cost by simply dividing the NPV with the present value annuity factor. Now, present value annuity factor for first year, it is 0.9091. What's the present value annuity factor for year 2?
Year 2, 1.7355.
1.7355. Year 3?
2.4866.
2.4866. Okay. So annualized NPV is NPV divided by present value annuity factor. It is 309090 divided by 0.9091, which is 339996. Okay, then 547108 divided by 1.7355, which is 315245. And then we have 7,89,794 divided by 2.4866, which is 3,17,620. So out of this, which is the least cost option? Out of this, which is the least cost option?
Year 2.
Year 2.
Right. So we should replace the taxi at every second year. So use it for 1 year and then another year and then replace it. Got it, everyone? Yeah. Are you getting it, everyone?
Yes, sir.
Yes.
Yes, sir.
Okay. Okay, fine. So that's the replacement decisions that we do. So it's like we have decided whether to replace or not, and second is when to do the replacement. I hope the methods are clear. Now we have one aspect pending, which is that adjusted NPV. Okay, now let's go ahead with that adjusted NPV calculation. Or rather, I would like you to solve a similar replacement question. Net cash flow of 50,000. Okay. Look at this question. Question 27, guys. Company Y is operating an elderly machine which is expected to produce a net cash inflow of 40,000 in the coming year and 40,000 next year. So useful life of this machine is 2 years. Current salvage value is 80,000. Next year salvage value is 70,000. The machine can be replaced now with a new machine which is going to cost you 1,50,000, but is much more efficient and will provide a cash inflow of 80,000 a year for 3 years. Okay. Now company Y wants to know whether it should replace the equipment now or we should wait for a year with a clear understanding that the new machine is best of available alternatives and that it in turn can be replaced at the optimal point and the cost of capital is 10%. So we have to decide whether to replace now or whether we should replace it after a year. Okay. So that is what we are going to decide, whether the replacement should be undertaken now or whether the replacement should be done after a year. I'll just give you a couple of minutes. Just think of it. Or would you like to try it on your own? In a rough way? NPV of the machine being replaced today and NPV of machine being replaced after a year. Would you like to try? Or shall I take it forward? Yes. I'll just do it. Wait. Then. So here we have this question. It's a bit different question because you have a cash inflow also over here. So you've got two choices: replace the machine today or maybe replace the machine a year later. Okay. So first, to decide whether to replace today or whether to replace after a year, I need to first get what is the NPV of new machine. What is the NPV of the new machine? Yeah, guys, tell me, what's the NPV of the new machine? How do we calculate the NPV of the new machine? So for that, investment. What is the investment required to have a new machine?
1,50,000.
Okay, so 1,50,000. The PV factor is 1, so we take it a cash flow as 1,50,000. Then, what are we going to get from this new machine?
80,000 cash inflow.
80,000 cash inflow, right? So we'll talk of present value of cash inflow, which will be 80,000 into, give me the present value annuity factor.
10%.
How much is the present
Yeah.
value factor?
2.4869.
Okay. So what's this number?
So it's 1,98,952.
1,98,952. Okay. Do we have any salvage of the old machine? Salvage of the new machine, sorry.
No, sir, it's not mentioned.
Not
Given.
mentioned. So we can say NPV of new machine. It is 48,952.
Yes, sir.
Right. So whether you replace the machine today or you replace the machine after a year, at that particular point of time, whenever you're replacing, you get a you get a NPV positive of 48,952. Correct?
Yes, sir.
If you replace in year 0, you get a NPV in year 0 to be 48,952. And if you replace in year 1, you get a NPV of 48,952 in year 1. Okay. So now let's look at the replacement decision. So let's say option 1 is replacement of the machine today. So talking of replace machine today. So if you are going to do the replacement today, we'll talk of year, cash flows, PV factor, and PV. If I'm going to replace the machine today, am I going to have any benefit from sale of old machine? Yes. What's the salvage of the old machine?
So please show the question, sir. First.
Yeah. Salvage of the old machine.
80,000.
80,000?
80,000 current year. Yes, sir.
Okay. 80,000. Then what's going to be the PV factor for that?
80,000. 0.9091.
Or 0. PV factor will be 1.
Sir, one only. It's current year, one only. It's not the end of the year.
Yes. And today, if you replace, you are going to get an NPV of 48,952 from the new machine. So this is 48,952. In both cases, you have a cash inflow. So this 48,952 is the NPV that you will get today if you replace the machine today. So the total NPV that we have is 1,28,952. Right? Second option is replace machine 1 year later.
1 year later.
So if you're replacing the machine 1 year later, year, cash flows, PV factor, and the PV. So we have year 0. Anything happening from year 0? In year 0, nothing happening, sir, because no cash flow, nothing. But in year 1, you'll obviously have the 80,000 salvage. No. What's the salvage after the year?
70,000 salvage and 40,000.
70,000 salvage and 40,000 will be the 1 year cash flow.
Yes, sir.
You have 40,000 as the first year cash flow and also 70,000 as the cash flow over here. Okay. What will be the present value factors? Also, you will get this NPV of 48,952. You will get 48,952 as the cash flow in year 1. Okay. So 48,952, that's the NPV. So let's write down the PV factors. It's 0.9091 everywhere. What's the PV over here? What's the PV, guys?
1,44,503.
Right, sir, exactly.
1 lakh
44,503.
503. 1,44,503. That's the NPV. So now what will be our decision? Should we replace today and get an NPV of 1,28,000, or should we wait for a year and then get an NPV of 144?
We will wait for a year, sir. The NPV is higher.
Because the NPV is highest in that case. Got it, guys? Yeah?
Yes, sir.
Easy? That was question 27, which we did. Okay, now,
Sir, I need small clarity. On the option number 2, why again we are discounted to 0.9091?
because you want to take it up to present value. This 48,952, this is you're going to get the NPV in year 1. But if I want to compare both of them, I need to bring both the cash flows at current level, which is today's level.
Oh, okay, fine, sir.
Right? You got this
Right.
48,952, but I need to bring all cash flows in year 0, right? So that both the options are comparable.
Correct, sir.
Right?
I lost my connectivity on this.
Okay, no issues. Fine.
सर 80,000 एवरी ईयर मिलेगा हमें, मतलब रिप्लेसमेंट करें या नहीं करें?
80,000. Where is that 80,000? 80,000 is the salvage value, right?
Cash inflow is also 80,000.
The old elderly machine is expected to produce a net
Will
cash flow of
provide for cash inflow for 80,000 for 3 years. If we are replacing second option, then cash inflow for only 2 years.
80,000. No, that 80,000 is already accounted over here, right? When we computed the NPV. So that 48,952 is the NPV of that 80,000 that you're going to get every year. You will get this NPV. You'll enjoy this NPV today itself if you replace today. You'll enjoy that NPV after a year if you're replacing after a year. Got it? So we already have accounted for this. So simply speaking, we are, like this. 0, 1, 2, 3, and 4. Right? So when you're replacing it, this 48,952, you're going to get the present value of all 3 cash flows over here. Right? And also you have that 80,000 over here. Right? So total comes out to be that way. In case of second option, we have like 0, 1, 2, 3, and 4. Now you start getting the cash flows from first year onwards. So in first year, you have 48,952. Okay. 48,952 when you discount it back, right? That is what we have considered over here. That since this cash flow is to be checked with this one, we need to take that decision accordingly. So we are taking the NPV as of today. That 48,000 is the NPV that you will enjoy. 48,000 is the NPV that you're going to enjoy if you are having the replacement done anytime. So if you replace today, you get that NPV today. If you replace 1 year later, you get that NPV 1 year later. Okay.
We're replacing in second year, then the NPV is 48,952 same.
Yeah, 48,952 happening in first year. 48,952 is the present value of cash flows up to first year. I discount it further to bring it up to year 0 level. So this 48,952 is the present value up to first year, like second year cash flow discounted to first year, third year cash flow discounted to first year, fourth year cash flow discounted to first year. And that entire thing is then brought back to the year 0 level.
Okay, sir.
Got it? Okay. next one. Okay, well, we'll do this next concept before we go for the additional questions that we will solve. So something called as now the adjusted present value. Adjusted present value. Okay. Do we remember from CA Inter capital structure? There we had something called as model with taxes. Do you remember? Model
Yes.
with taxes.
Yes, sir. It's relating to capital structure.
Relating to capital structure, agreed. But in that model,
Without tax.
if you can just recall model with taxes, the model was simply that value of levered firm will be equal to
Value of unlevered firm minus
unlevered firm plus debt into tax rate, right? Do you
Yes,
remember
sir.
this? Yeah. So model with taxes, value of levered firm was equal to value of unlevered firm plus debt into taxes. Now this debt into taxes, this particular portion was actually nothing but present value of all future tax savings. The present value of all future tax savings on interest payment, right? Just a moment, Avish. Okay, so model, we said that value of levered firm will be equal to value of unlevered plus debt into taxes. Now, this was nothing but present value of all future tax savings on interest. Now, what will be the amount of tax savings on interest? Tax savings on interest. Can I say it will be interest, the amount of interest into the tax rate? Tax
Yes,
savings on
sir.
interest will be
Yes,
the
sir.
amount of
Yes, sir.
interest into the tax savings, right?
Yes, sir. We can say that.
Right? Tax savings on interest will be interest into tax saving. Now, this is going to be happening per annum. And this is going to be the tax saving till perpetuity. Right? So this is going to be there till perpetuity. Now, if I ask you what is present value of all such tax savings, you simply say interest into tax for the first year upon 1 plus KD, which is the first year tax saving, plus interest into tax saving upon 1 plus KD square, plus interest into tax saving upon 1 plus KD cube, and it goes on till perpetuity. And if you just solve this by method of a geometric progression, you get this as interest into tax rate upon KD. And this portion, which is interest upon KD, what does that indicate? What's the value of interest upon cost of debt?
It is a value of the debt.
Yes, that's the value of the debt into tax. And that's where you get this particular number. Okay. So similar line, we can say, when we have the present value, adjusted present value calculated, we have the adjusted present value calculated. That is where we are going to look into this same concept. Okay. Now, adjusted present value will be equal to base case present value plus present value of tax savings on interest. Base case present value plus present value of tax savings on interest. Okay, so adjusted present value is base case present value plus present value of tax saving on interest. Now, base case present value is, this is the present value of project if it is fully funded by equity. So present value of project, if it is fully funded by equity, that's going to be the adjusted present value. Okay, so adjusted present value is base case present value plus present value of tax saving on interest. So base case present value is the present value of project if it is fully funded by equity. Right? So let's try to understand this with the help of this example. Initial investment in a project involves an outlay of 6 lakh. So you're going to make an investment of 6 lakh. The project will be funded by debt and equity in the ratio of 60:40. So out of this 6 lakh, 60% is going to be debt and 40% is going to be equity. Okay. So here we can say initial cost is 6 lakh. Cost of equity is 15%. Cost of debt is 10%. Okay. And we have cash flow after tax per annum. Right. So CFAT, cash flow after tax is 2 lakh. Okay. And this is all happening till perpetuity. Okay. This is all happening till perpetuity. So if I ask you, what is the NPV of project if it is fully funded by equity? NPV of project if it is fully funded by equity. What will be the NPV of project if it is fully funded by equity? If it is fully funded by equity, it's going to be like cash flow after tax you discount it by 15% till perpetuity.
Yes, I said 13 lakhs 33,333.
And from that, we are going to subtract the initial cost, which is 6 lakh. Right. So base case NPV is 7,33,333. Correct? Correct, yes?
No, sir. It's a 2 lakhs to be 15.
Yeah. 2 lakh divided by 15% minus 6 lakh.
Yes, sir. 7 lakhs. Yeah.
Correct, no? 7 lakh 33,333.
Yes, sir.
Okay. Then we talk of what is the tax saving that we have on interest. Tax saving due to interest. How much is the tax saving due to interest? Can I say 6 lakh is the initial cost? On that, 60% is the cost of debt.
3,60,000.
And on that, we are paying how much? 10% tax.
10%.
On that, so 10% is the interest, and we are saving 30% tax on it. So that is 10,800 every year. The present value of all future tax savings is going to be 10,800 divided by cost of debt of 10%, which is
1,08,000.
1,08,000. So when we say what is the adjusted NPV, that's going to be simply 7,33,333 plus 1,08,000, which is 8,41,333. That's the adjusted NPV. Right? So it's similar to the Modigliani-Miller model that we had. Right? It's similar to the Modigliani-Miller model. It's just that you have to take the base case NPV and add to that the present value of all future tax savings. Okay. Are we good, guys? Clear?
Sir, why we are reducing 6 lakhs there?
Where? How do you calculate NPV then? 6 lakh is the investment that you make today, right?
Okay, right, sir. There is a cost. Okay.
There's a cost involved in that.
Right, sir.
Okay.
Here the assumption is that it's fully funded by that equity.
In the first case, it's fully funded by equity. And the second case, when you say that it's going to be funded by debt, so on that debt you're having tax saving, the present value of all of that is accounted here.
Okay, here we are drawing the concept of model.
Yeah, same model. Same over here. Value of levered is calculated as unlevered. So unlevered is basically base case NPV assuming fully equity. And then you have the debt into tax, which is the present value of tax saving on interest. Are we good, everyone? Easy? Yep. Everyone, are we good?
Yes, sir.
Okay.
Good, sir.
Fine. This is done. Okay, let's do one thing then. Let's take a break right now because we're done with all the concepts. We just have to do some practice problems and certain MCQs, which we will take it up after the break, guys. Okay, so let's take a break. and then meet up back with some more questions and then also the MCQs.
Okay, sir.
Okay. Okay. Let's take up some more questions for discussion. Okay, let's take up this question number 19, guys. Yeah, question number 19. Just read it once. So the Easygoing Company Limited is considering a new project with initial investment for product survival. It estimated that IRR of the project is 16%, having an estimated life of 5 years. Okay. You can see IRR over here is 16%. This is the question 16 from the handout. IRR is 16%, which has an estimated life of 5 years. So life of the project is 5 years. Life of the project is 5 years. Financial manager has studied that the project with sensitivity analysis and informed that annual fixed cost sensitivity is 7.8416%, whereas cost of capital discount rate sensitivity is 60%. Okay, so financial manager is having a sensitivity analysis and informed that annual fixed cost is having a sensitivity of 7.8416, whereas the cost of capital sensitivity with the discount rate is 60%. Now, what do you mean by this sensitivity over here? Right. So before we do with this sensitivity analysis, first we need to calculate the initial investment of the project. Now, PV ratio is 70%, variable cost is 60, annual cash flow is given as 57,500. So ignore depreciation on initial investment and impact of any taxation. So there's no impact of taxation and other aspects. So first we have to get the initial investment of the project. So how do we get the initial investment of the project? How do we get the initial investment of the project? Since the IRR is 15%, can I say at IRR of 16%, present value of cash outflows is equal to present value of cash inflows. Present value of cash outflows will be equal to present value of cash inflows. Now, how do we get the present value of cash inflows? That will be cash flow after tax per annum into present value annuity factor at 16% for 5 years. So cash flow after tax is 57,500 into present value annuity factor is 3 at 16% for 5 years. Can you tell me what's the present value annuity factor? I think that's given in the question, 3 point something. Yeah. This is 3.274.
1,88,255.
Okay, 1,88,255. can I say this is nothing but the initial investment that you're making? Right? So initial investment is 1,80,255 because I've discounted
Yes.
all my future cash flows at IRR. So at IRR, PV of cash outflow is equal to PV of cash inflow. The investment that you're making, that's equal to the present value of cash inflows. 1,88,255. Okay. Now we have got some sensitivity number. It says that annual fixed cost is having a sensitivity of 7.8416%. Okay. And cost of capital, which is discounted, has got a sensitivity of 60%. Now, they have not specified anything about the cost of capital. Now, what do we mean by this sensitivity of 60%? What do you mean by sensitivity of 60%? It means if cost of capital increases by 60%, okay, if cost of capital increases by 60%, NPV will become 0. So at current cost of capital, you have NPV positive. But if your cost of capital increases by 60%, right, then your NPV is going to become 0. Right? So we'll say, let the cost of capital be X. Let cost of capital be X. Okay. Let cost of capital be X. And since sensitivity is 60%, this simply means calculate the cost of capital at which your NPV is becoming 0. The cost of capital at which NPV is equal to 0, that will be X plus 60% of X, which is 1.6X. Okay. So at 1.6X, the NPV becomes 0. Right? Now, since we know NPV is 0 at IRR of 16%. So at IRR of 16%, net present value becomes 0. NPV is 0 at IRR of 16%, right? So we can say NPV works out to be 0 at an IRR of 16%. So it essentially means that 1.6x is equal to 16. Okay, 1.6x is equal to 16. So x is going to be how much, guys?
25.6.
10%, right?
Sir, it's 10%.
10%, yes. So x is 10%. Right? So 1.6x is 16%. So we can say x is 10% over here. Okay. Now, since we have this x as 10%, we got the answer of initial investment. Now we can get the net present value of the project. NPV of project at cost of capital of 10% is going to be, what is your initial investment? 1,88,255. And every year the cash flow is 57,500. So 57,500 into present value annuity factor at 10% for, what's the tenure? 5 years. Minus Initial investment of 1,88,255. Okay. So what's the NPV of this project?
So what is that PV factor for 5 years, sir? The 10%?
This
No,
is
no. It is
3.79.
provided in the question itself. So we need to use that.
Yes, yes.
It's 29,728.
Okay. 29,728. That's your NPV of the project. Second part is done. So this is done. This is done. Now, what's the annual fixed cost that we need to have? Now, for that, we have the sensitivity given to us. Its annual fixed cost needs to be computed. We have a sensitivity given to us, which is 7.8416. Now, again, 7.8416 simply means that if your fixed cost increases by 7.8416, the NPV is going to become 0. Okay. If your NPV, if your fixed cost increases by 7.8416%, NPV is going to become 0. So we'll say one more thing over here is that we need to get the units of sales. So unless we have the units of sales, I can't do any other further calculation. So we'll say let original fixed cost is equal to rupees Y and units is equal to rupees Z. Sales units, we say it is Z, right? Now, what is the sale price per unit? Sale price per unit is 200. From that, we will subtract the variable cost. So what is the variable cost given in the question? Okay, variable cost is given as 60 and PV ratio is 70%. So that's what we have computed already. So variable cost is 60. Right? And then we have the contribution as 140. Right? So contribution is 140. So essentially your PV ratio is 70%. So contribution will be 70% of sales. Variable cost is 30%. So 100% will be, of course, 200. So contribution is 140. Then we have the total contribution to be 140Z. Total contribution is 140Z. From that, we are going to subtract the fixed cost. So fixed cost is going to be Y. So we get the cash flow after tax is 140Z minus Y. And this is equal to 57,500 because we have already got this every year cash flow of 57,500. So about every year cash flow of 57,500. So we got this equation. 140Z minus Y is 57,500. This is our equation number 1. Now do we get the second equation? For that, we have to calculate the revised NPV. Okay, so revised NPV, for that we need to get the revised cash flow, and we know revised NPV is going to be equal to 0. So let's first talk of what will be the revised fixed cost. Originally, fixed cost, we have taken it as Y. So Y. On that, we are adding 7.8416%. Y plus 7.8416% of Y. So this is Y into 1.078416. So this is 1.078416Y. Okay. Then we need to compute the revised cash flows. Now, what will be the revised cash flows, guys? because we know the contribution was 140, only the fixed cost is changing. Right? So it will be revised cash flow will be 140Z minus 1.078416Y is the revised cash flow. Then what will be the revised NPV? Revised NPV is 140Z minus 1.078416Y into PV factor was 3.791 at 10%, right? Minus initial investment which we are making, initial investment of 1,88,255. 1,88,255. Right, so this revised NPV is working out to be how much? Now we know that this revised NPV is going to be equal to 0. Right, so let's just multiply it. I mean, we can simply say this as 140Z minus 1.078416Y into 3.791 is equal to 188,255. So we can get 140Z minus 1.078416Y is equal to 188,255 divided by 3.791. 188,255 divided by 3.791, which is 49,658.4. So we have this as 140Z minus 1.078416Y. This is our second equation. So we have both the equations in front of us. Can you solve both of them simultaneously? Like one of the equation is this. 140Z minus Y is 57,500. And then we have this second equation. Can you solve these two equations simultaneously and give me the value of Y and Z, guys? Yeah. Can you solve it and give me the value of Y and Z? Yes. Give me the value of Y and Z, guys. What you need to do is just change this equation sort of thing.
1 lakh, sir.
You can simply change this as Y is equal to 140Z minus 57,500. Right. You can just replace Y in place of this and get the value. Or else you can also do some sort of equation sort of thing. So what's the
Sir,
value?
we can direct, sir, subtract equation 1 from equation 2.
Yes, we can.
140Z, 140Z will cancel.
Yes.
So Y is equal to, we get 1 lakh.
So Y is equal to 1 lakh.
Yes, sir.
Y, which was actually the, what was Y, by the way? Fixed cost, yeah. Y is fixed cost, which is 1 lakh. And what's the value of Z? Value of Z? What's the value of Z?
It's at 303.
303.57.
Sorry?
303.57.
303.57.
Yes, sir.
Just check, guys.
Yes, sir.
So you substitute the value of Y over here, which is 1 lakh. So that gets added 1,57,500 divided by 140. 1,57,500 divided by 140. It's 1125. This doesn't seem to be the answer. Where have we substituted this Y? So we'll say substitute
To the first equation.
Y equal to 1 lakh in first equation. So first equation is 140Z minus Y is 57,500. So 140Z minus 1 lakh is 57,500.
1125, sir.
So 140Z is 1 lakh 57,500. So Z is 1 lakh 57,500 divided by 140. 1125.
25.
Yes. Number of units is 1125. Then the question, so we got the annual fixed cost, we got the estimated units of sales, then the break-even units. Now, how do we calculate the break-even units? How do we calculate the break-even units? Yeah. Break-even units will be fixed cost upon contribution per unit. The fixed cost is 1 lakh upon, what's the contribution? 140 per unit, right?
Yes.
Break-even is 714.29 units. Did we get this, everyone?
Yes, sir.
Okay. That's the end of this question. Okay, let's go ahead with this question 21 now. Question 21. A firm has an investment proposal requiring an outlay of 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. Okay, so it has got a 2 years life with no salvage value. In year 1, there are 2 scenarios possible. 40% chance that you will get a cash flow of 50,000. 60% chance that you will get a cash flow of 60,000. Okay, 40% chance that you will get a cash flow of 50,000 and 60% chance that you will get a cash flow of 60,000. The probability assigned to cash inflow after tax for the year 2 are as follows. So cash inflow in year 1 is 50,000 and 60,000, and both of them are having a probability of 0.4 and 0.6. Okay. So year 2, we can have the cash flows of, like, if first year turns out to be 50,000 cash flow, then it's going to be 24, 32, and 44. And if the second year it turns out to be 60,000 cash flow, then it is 40,000, 50,000, and 60,000. The firm uses a 10% discount rate for this type of investment. Okay, so the firm uses a 10% discount rate for this type of investment. Then we have to prepare a discount decision tree for proposed investment project and calculate the expected NPV. What NPV will the project yield if the worst outcome is realized? What is the probability? What will the best outcome and the probability of that occurrence? Will the project be accepted or not? Okay. NPV will the project yield if the worst outcome is realized? What is the probability? Now, we have to prepare a decision tree for this. So we can have like two possible scenarios in year one. So we'll say year 0, year 1, and year 2. So if you take up the project today, you may face two situations. That in year 1, you are getting a cash flow of 50,000, right? And second chance is that you're getting a cash flow of 60,000.
60,000.
Okay. What's the probability of the first year cash flow being 50,000?
0.4.
0.4. And this is obviously 0.6. Right? Then, if first year cash flow turns out to be 50,000, then what are the cash flows likely to be in year 2? It is 24,000, 32,000, and 44,000. What are the probabilities given? 0.2, 0.3, 0.5. 0.2, 0.3, 0.5. Okay. Then this 60,000 can again be further possible 3 different scenarios. What's the likely cash flows in second year? If 60,000 is the cash flow in first year, it is 40, 50, and 60,000. And the probabilities are 0.4, 0.5, 0.1. Okay. So this is a typical set of cash flows we may have. So how many total possible scenarios are there, guys? How many total possible scenarios are there for NPV? So we can say somewhat like this: year 1. In year 1, we'll talk of probability and cash flow. And then again in year 2, we talk of probability and cash flow. So with 0.4 probability of cash flow being 50,000, you have 3 different scenarios, which is 0.2, 0.3, and 0.5. So what are the 3 cash flows? 3 cash flows are like 24,000, 32, and 44. Right? So one set of thing is that first year you get a cash flow of 50,000, and second year there are 3 different possible scenarios. And the next set is with a 0.6 chance, cash flow of 60,000, and the probability numbers are going to be 0.4, 0.5, and 0.1. Right? So this is going to be equal to, like every year you're going to have 40, 50, or 60. Okay. 40,000, 50,000, or 60,000, these are the cash flows. There are total, we can say scenarios are in total 6. And we can obviously say what is the combined probability. Can you tell me what will be the combined probability of, first year being 40,000, second year being 24,000? The combined probability will be 0.4 into 0.2, which is 0.08. Then it is 0.4 into 0.3, 0.12, right? Then it is 0.20, 0.24, 0.30, and 0.06. So these are the probabilities. So 0.08 is the chance that you will get in first year 50,000 and 24,000 in the second year. 0.12 is the chance that you will get 50,000 in first year and 32,000 in the second year. 0.2 is the chance that you will get 50,000 in first year and 44,000 in the second year. Okay, so these are the combined probabilities. Okay, these are the combined probabilities. Now we have to get the present values. So we'll simply take the NPV number. NPV is going to be calculated as cash flow in year 1 into what's the discount rate? 10%. Okay, so discount rate is 10%. So cash flow in year 1 multiplied by 0.9091. That's the PV factor for first year. To that, you are going to add cash flow in year 2 into. Can you tell me what will be the PV factor for the second year at 10%? What's the PV factor at 10% for the second year?
0.8264.
0.8264. And from that, we are going to subtract the initial investment. Initial investment is basically 80,000. So minus 80,000. So we can calculate the NPV every time over here. Sure. Give me the cash flow over here. I mean, NPV in the first scenario. 50,000 into 0.9091 plus 24,000 into 0.8264 minus 80,000. What will be the NPV in first scenario? It is 50,000 into 0.9091, right? 45455, and then add to that 0.8264 into 24,000. That is 65,288 minus 80,000, which is 14,711. That's a negative number. Same way, can you calculate the NPV for all other values? Yep. Can you calculate the NPV for all other values? All other streams? What's the second value? Just check. Second value is 50,000 into 0.9091. Add 0.8264 into 32,000 minus 80,000, which is negative 8,100. Okay, then next, the next number is 50,000 into 0.9091. Okay, then add to it 44,000 into 0.8264 minus 80,000. That's 1799 positive. Okay. Same way, we can get the other values as 7,580, 15,840, and 24,100. And then we take the, we already have the probability numbers here. Just we need to do is NPV multiplied by probability and then take a total. So we can get the expected NPV in this way to be 6,224. Okay, so in this way we can have a tree diagram based NPV also. Are we clear, guys?
Yes, sir.
Yeah. Okay. Let's then take up certain questions for MCQ. Just give me a moment. I'll share this.
Sir.
Yeah.
Should we take combined NPV, or we can take a different probability for year 1 and year 2 and then add up?
No, you have to combine. You have to take combined probability.
Okay, sir.
Because it's a probability for both the events occurring.
Okay, sir.
Let's wait. I'm just opening up the MCQs. Okay, let's take up the MCQs one by one. Can we see the screen?
Yes, sir.
Yes. Okay. Tell me, which of the following is not a relevant factor while evaluating a replacement decision in capital budgeting? Yep. What do you feel? Which of the following is not a relevant factor while evaluating the replacement decision in capital budgeting? I mean, which of these numbers are not considered while carrying out the replacement decision? Salvage value of old machine or old asset, book value of old asset, incremental operating cash flows, change in maintenance cost. Which one do you think is not a relevant or not a factor which should be considered?
Sir, B, book value.
Book value, absolutely correct.
Book value of the old asset, sir.
Yeah. You don't consider the book value of the old asset. Had it been a question that, had it been, option like, not the book value, but value of asset in income tax, then this wouldn't have been the answer. But since they're saying book value, you have provided the asset in the book value basis, so tax impact is not at all considered over there.
Right, sir. We consider that WD of old asset.
Yes.
To add, yeah.
Okay. Try out this question. A machine costs 12 lakh and it saves 3 lakh annually in operating cost. Its life is 5 years with no salvage value. If the discount rate is 10%, should the machine be purchased? Yep.
No salvage value. It's 12 lakhs.
Yes, sir.
62,000.
Is the correct option?
C, sir.
Option C. Hmm. This is the correct option. If I ask you what is present value of cash inflows, what can you say about it?
3 into 5, 15 lakhs.
3.791 into 3 lakhs. Right? Because 3 lakh is annually happening and this is going to be over 10 years and discount factor is given. So we can simply say 3 lakh into 3.791, 11 lakh 37,300. That's present value of cash inflow. Okay. And then present value of cash outflow. It is 12 lakh. You just subtract. This comes out to be 62,700 negative. Right?
Yes, sir, that is correct.
Correct, yeah.
We
So
do not have that in options.
in option, yes. So I think this is no
The
answer.
incorrect option provided.
Yeah, this will be
But in this case, if you tick any of the option, the answer will be mark will be provided, right, sir?
sorry.
Sir, in this case, mark whether the mark will be avoided if
Yeah.
you choose any one of that.
Yes. Okay. Then let us take up the next one. In adjusted present value, which of the following is added to the base case NPV? Tax shield on depreciation, financing side effects like interest tax shield,
Interest tax shield, sir.
cost of capital, or terminal value. Can I say financial side effect of interest tax
Yes,
shield?
sir. Interest. The option B, financial shield effect.
Correct. Okay. Next question. A project has a base case NPV of 2,50,000. The present value of interest tax shield due to financing is 50,000. What will be the adjusted NPV? What is the adjusted NPV?
It's 2 lakhs, sir.
2 lakh. It should be 3 lakh.
Yeah, we need to add that as well.
So 50,000.
Yes, sir. It's
like
3 lakhs.
3 lakhs. Correct. Then next one. In decision tree analysis, value of each decision node is determined by average of all outcomes, sum of all payoffs, probability weighted average of possible outcome, highest possible payoff among outcomes.
Weighted average.
Probability weighted average, right?
Yes, sir. Weighted average.
Correct. Yes. Okay. So with that, we have done these MCQs and also the topic of advanced capital budgeting comes to an end. Okay. Any queries? I will address that, or else we'll call it a day. Any queries, guys?
The Jagmantuji, is there any query on the query handle? Just check this.
No.
No. Okay. Just okay, students. Thank you very much. I think with this we have gone through our 3 chapters of our paper number 2, Advanced Financial Management. So overall, we can say that we have covered 1/5 of our part of our overall syllabus, because it overall 15 chapters are there, and out of that we have covered 3 chapters. Now in the next class we shall start with a new topic, and thank you Jagbandhu sir for sparing your precious time. Now I request you write down our email ID or phone number so that student can communicate with us. Yes, student, this is our email ID as well as phone number. If you have any query, you can contact us, or you can send the email at the same email ID. Okay, student. So revise whatever we have discussed in today's class. So we shall start in the next class with a new topic. Thank you, student. Thank you. Have a nice day. Thank you, Jagbandhu.
Thank you, sir. Have a nice day, sir.
Thank you. Thank you. Thank you. Thank you. हाँ, बस देख लेते हैं, कोई अगर क्वेरी कभी स्टूडेंट कोई पूछ ले, क्वेरी कई बार होता है, वो थोड़ा सा पूछ लेते हैं. ओके.
लाइव बंद कर दीजिए.
वो बंद कर दीजिए लाइव. ओके.